Hi, this is Michael Carlin, president of Henry & Horn Wealth Management with your Manage the Funds podcast. Today, what we're looking to do is we're going to try to spend about 10 minutes, no promises. For those regular listeners, you know sometimes I can talk. We have got to unpack and go through the China tariff trade situation that we're dealing with. We got to go through it for a variety of reasons because there's a lot of confusion. I talked to a business owner today, and the business owner said that the China trade deal and the resulting tariff, I know it's increased the price and the cost for him to do business. The China tariff, he has to deal with steel. And the cost for his steel went up, which means that they make less money on the things that they were doing. And it was contrary. He said, this is the best thing that's ever happened to me in my business career. And I was like, whoa. I said, well, what happened? He said, well, there's a whole bunch of other companies that were competing with us in this increased cost. Make sure that the cream rises to the top. And as a result, some of our competitors have gone away. So this underscores the point of, one, obviously, if you're a great organization, you can navigate difficult times and tariffs and things like that happen to your business. But two, it also underscores the fact that it's a real thing and it does impact American businesses. So let's kind of set the stage on what has gone on with this tariff. You may recall in 2018, well, you may not recall, but let's just kind of set, again, the big picture is in 2018, we did $540 billion of business with China. And included in that are semiconductors, auto parts, steel, sneakers, laptops. Think about it. You know all the things that we're getting from China. Over that same time period in 2018, we sold to China about $120 billion worth of stuff. So about a fifth of what we're sending them, a fifth of what we're consuming. This gets lost. We're consuming more from China than we're sending them, because we're consuming here in the United States more than we can produce. We've got to get it from somewhere. We've got to get the stuff from somewhere because we can't produce enough of it at the right cost. So we have to get it from China. So there's this trade imbalance where many say, well, they should be buying $540 billion worth of stuff from us. Well, that's not really how it works. We're consuming more. We need to get it from somewhere, so China's a great place to get it, specifically because of the costs. Well, in 2018, the U.S. imposed tariffs of 10% on $250 billion of the $540 billion of Chinese goods that we are consuming. And then we ended up raising the tariff to 25%. In August of 2019, Trump announced an additional new 10% tariffs on $300 billion of goods. Some of those goods were exempted to later in the year. And there were plans that they want to have a duty of 25% if the two sides fail to reach a deal. So the administration's objective was to put, a pretty massive tariff on all Chinese goods coming into the country. So you also look at what China didn't just, do nothing. They retaliated and they put tariffs on what they were importing from us. We're going to talk a little bit more about what that was, but that was that retaliatory tariff looks like it will hurt our exports to China by about 18%, or maybe as much as $22 billion this year alone. Less goods potentially sold to China because they tariffed our stuff. We'll talk about what that stuff was. And really what this means for you as an investor is that all American consumers, we're paying some portion of these tariffs in the form of higher prices. You got to know that. You got to know that it's not just happening in a vacuum. Now, in some cases, maybe a business can absorb. They may not just mark up the price of their product exactly what the tariff was, but the business is paying for some of it in the form of lower profits because they're absorbing some of it, and the consumers are paying it as well. So, when you're looking at how this thing starts to come together, we got to at least examine first, how are the countries going to withstand this whole thing? So China's total economy is $14 trillion. They're growing, the growth numbers that they've projected are 6.2% for the year. And if you look at what a $55 billion loss, which is what we're, because again, we're doing less business with China to the tune of $55 billion. That $55 billion loss for an economy of $14 trillion means that they're growing at 6.2%, but if they didn't have that loss of business, they would have been growing at 6.6. Step back for a minute. Growing at 6% is outstanding, albeit for China, that's slower than it has been. It's still outstanding. And for them to be growing at 6.2 when they could have been growing at 6.6 isn't a disaster. It's not a disaster. It's not great. It doesn't mean that the economic world in China completely folds up, but let's just look at it for what it is. It's a loss, and they can, they have an ability to absorb it. So, sometimes when you hear the Trump administration saying, "Well, wow, this is, we're crushing them," let's kind of look at it for what it is. The data suggests that they're growing less. It's okay. They're not folding up shop. So let's look a little bit more about the impact. So it's interesting to note that every time there's a major announcement or speech about this trade deal with China, the market goes down because it's typically been negative. The Trump speech at Davos being the first, the Pence China Cold War speech being another, the trade talks breaking down in May of 2019, the tariffs escalated in the middle of 2019, and then here just yet again in December, we have another couple of really rough days because there's fear that these trade talks are breaking down. So one of the big impacts is that the trade talks impact the stock market because there's fear and anxiety that this trade deal is going to get worse and it's going to hurt businesses, it's going to hurt consumers. But the purpose for this podcast is to explain what's going on and then look at the data and see, is that even true? Is that really what's happening? If you look at things like, there's these ISM indexes, and essentially what it is it will measure how much the U.S. economy is growing for both manufacturing and the non-manufacturing or services part of the economy. And it's hard to mistake the fact that both of those growth measures or measures of the economy, they've been growing less. And in fact, the manufacturing part of the U.S. economy is in contraction. So some say the manufacturing side is in contraction because of these tariffs. But if you look from a historical context, manufacturing goes through cycles. And this really feels like a cycle where, again, you produce too much, then you got to produce less, and then you run out of inventory, and then you got to produce more, and then manufacturing goes up. It is a cyclical thing. So I don't know if there's necessarily a direct tie between the manufacturing index going down and the tariffs. You also look at the services part of the economy, which is 80% of our economy. And the rate of growth for the services part of the economy has been slowing too. It's still expanding, but expanding less quickly. What that essentially means is that, again, 80% of our economy is still growing. The economy is still moving forward. So can you relate the tariffs to the kind of these slowing PMI numbers or these slowing PMI numbers on both, with regards to the ISM manufacturing and non-manufacturing? And the answer is it's not directly conclusive. And it kind of, if you look at China's strategy here, they're looking at $55 billion less business with the United States, which hurts their economy. But how much does it really impact them? Because a lot of the goods that we're talking about are built not just in China, but they're built in Japan and in Vietnam and Canada and sometimes they're assembled in China. And if you look, the real cost to China doesn't appear to be $55 billion. It appears to be about half that, about $20 billion. And, when you're looking at what China did with their tariffs, they went, with a really, we kind of went with across the board approach. They went very targeted. Some economists I've read said that they use a scalpel. And what they did is they slapped tariffs on soybeans, a 28% tariff on soybeans. I'm looking at 23% on wood and paper and metal products and chemicals. So they increased the tariffs on those kinds of things. And then at the same time, they lowered the tariffs on those same products from other countries from 8% to 6.7%. Increased the ones on the United States on certain products and then decreased other parts of the world so they could import them cheaper from other parts of the world. And they're the types of things that are really replaceable. Wood and paper and metal and base chemicals, you can get those from other places. And the result, because of the way China handled their tariffs, they're not paying a heck of a lot more for soybeans and chemicals and other products. And because they've handled the tariff in this way by tariffing the U.S. and by decreasing the tariff on others, there's kind of this no dead weight cost. That's what they refer to as dead weight cost. They're referring as to how much do the consumers have to pick up, and the answer is in China on those kind of products, not much or anything. On the other hand, the tariffs that we've got in place and we're looking to have a 25% across the board, American families will definitely pay more for sneakers and circuit boards and farming equipment, you name it. And so the Treasury, they recoup an equivalent amount of in tax revenue via these tariffs, and then the thought is going to be that a lot of the money that we are taking in tariffs, we are then rebating to the farmers and those who are getting hurt because they're selling less to China. So you can't even say that all the tariff money's coming in and it's great and it's going into our coffers. We are having to subsidize some industries, which is challenging. And in addition, there's going to be higher costs for imports here in the United States. And so there will be some kind of a dead weight cost here. So economists, and again, what you can do is you can lean on good data-driven economists that hopefully do great homework. They did estimate that the annual cost per household was $640 a year. And what that means is that we're all paying $640 a year for things that we're using throughout the course of the year because we're buying stuff that inevitably comes from China, and some of those prices have increased. Well, how much? To the tune of $640, and that depends upon what you're accumulating, what you're buying, what you're using. That's a total of $80 billion. That is $640 per household. The harder part to digest is that if indeed we do go forward with these tariffs of 25% across the board, look at the projections for 2020. Here's where the rubber hits the road. Here's what the market's worried about. This is it. That $80 billion deadweight cost is expected to rise to $160 billion. And that $160 billion, you're talking about, again, about almost $1,300 per household is what it would cost in addition to consume Chinese goods or goods that we're importing from China. And if you're looking at an economy, if we're hoping next year we're going to expand by $390 billion is kind of what we're hoping our economy would grow by, so not quite $400 billion. To have a $160 billion cost would be crazy because that costs us 0.9% or almost 1% of GDP. Whoa, wait a minute. A good year for us is growing at 3%, and we're going to lose 0.9 by paying higher costs from tariffs. That's crazy. So again, if you're kind of looking at this scorecard, because there's no deadweight cost from China, and yes, we are doing less business with them, they're looking to lose about 0.4% for their GDP. And if you look at where our lost exports were, because again, we're exporting less, but we'd still lose some. And then you add to that the dead weight cost that we just talked about. That's about 1% GDP. So now we understand with data. The trade deal certainly has a big potential U.S. economic impact. So we have this ridiculous cycle that happens where the administration looks at the stock market that's high and they feel good and they feel strong and say, this is working. And then they get tough on China and they say, I don't know if I feel a trade deal coming. I don't like the way things are going. The market goes down. And then over a period of time, at some point, we'll get some good news that the trade deal looks good. And then the market goes up. And then the administration feels strong because the market's up and says, I don't know if a trade deal is going to go through, and the market goes down. And then the cycle continues. The good news is that the amount that the market is going down is reducing, meaning the market's caring a little bit less and a little bit less about this, but it's gone on for a long time. So if we don't end up getting a trade deal and we do end up having these tariffs come into play, now you've got the data that will tell you some industries impacted more than others, some consumers impacted more than others. But this could be potentially a real challenging thing. So hopefully what we do see is we see some type of a phase one deal, which right now the market's, I believe, counting on. In this phase one deal will hopefully lead to additional deals where we can see great reconciliation with intellectual property rights, to guaranteed payments for our farmers in terms of guaranteed amount that they'll be consuming and all kinds of other great things that hopefully at the end of the day will create a even more confident business environment that will lead to higher prosperity. If you have any questions about anything that was in this podcast, send us an email, give us a call. You can always find us at Manage the Funds on social media. You can always direct message us there. You can give us a call, find us on the web at hh-wm.com. That's it for today. Take care and have a good one. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities. Member of FINRA and SIPC.